Let's start the next problem. When portion of abnormal goods are sold. Here is a problem. AB suffered a loss of stock due to fire on 19/8/2024. Prepare prepare statement of claim. We have to prepare statement of claim. And stock on 1/4/2023 is given. Purchases during Purchases during 23/24 is given. Sales during 23/24 is given. Closing stock on 31st March 2024 is given. This is the relevant information to prepare trading account for the year ended 31st March 2024. Why we prepare trading account? To get gross profit rate. Now let's continue. Purchase up to the date of fire and sales up to the date of fire is given, and closing stock on 31st March 2024 will be the same for the opening balance on 1st April 2024. Now here is the important adjustment is given. An, an, an item which was purchased in the year 22/23 at a cost of 10,000 was valued at 6,000 at the end of the year, which means this is a portion of closing stock. 10,000 worth closing stock was valued at 6,000, which means 4,000 is written off. So we will add back that 4,000 to closing balance of 22/23, which is uh, this is closing balance on 31st March 2023. Then the same will be the opening balance for 23/24. So 1st April 2023 is 28,000 is equals to 38,400 plus 4,000 is written off here. 10,000 valued at 6,000 at the year end, which means year end is when 31st March 2023. Then the same is carry forward to the opening balance of 1st April 2023. So it's equals to 4,000, which is 42,400. What is the value of abnormal stock? Total value, that is 10,000. Then normal stock is equals to total minus abnormal stock. Next, half of the stock was sold during 2023 to 24 in the financial year 23/24 for rupees 2,600. Half of the stock, which means 5,000 is the half of the stock which is sold for 2,600. Then incurred abnormal loss is 2,400. How? 10,000 into 50% is 5,000. 5,000 minus 2,600 is 2,400. Here abnormal sale is 2,000, 2,600, and abnormal loss is 2,400. 1,400. Then let's continue. And remaining was valued at 2,400. Remaining means 10,000, half is sold, 5% worth of goods is sold, then remaining is 50%, which is 5,000. 5,000 worth, but valued at 2,400. Then 5,000 is valued at 2,400. Then 2,000 600 is the loss. And what is the purchases during the year 23-24? 1,60,000. 1 lakh normal 1,60,000. Here sales is taken as total sales 2 lakh 2,600, 2 lakh 2,600. In that 2,600 is the abnormal goods sold. So therefore 2,000 2 lakh 2,600 minus abnormal goods sold were 2,600. Then the normal sale is 2 lakhs. Then anything else is remaining for the to prepare a trading account? No. This is relevant to June 2024, which comes in memorandum trading account. Just present year data. Okay. Then let's find out gross profit. Now let's find out gross profit. Okay, is equals to total of normal credit column minus sum of, which means total of debit column in the normal column, which is 7,600 is the gross profit. Here 10,000 is matching, here 10,000 is matching. Then normal closing stock is equals to total minus abnormal closing stock. Done. Done. Then let's calculate gross profit. Gross profit is equals to gross profit is 37,000 divided by 2 lakhs, which is normal sales, into 100, which comes to 19%. Okay, 18.5 round figure to 19%. It's better to take 18.5 as real. It will be 18.5% is the gross profit rate. How much is the gross profit rate? 18.5%. Done. Now opening balance. Opening balance is how much? Here opening balance. Here closing balance will be the opening balance. 31,800. 31,800. But the remaining abnormal stock was 5,000. Here we have calculated. You can check out. Here remaining was valued at 2,400 at the end of 23-24, but half of the stock was sold during 23-24, which is 5,000. Then the remaining value of abnormal stock is for 5,000. So the same is taken here. Abnormal stock is 5,000 is equals to 5,000. Normal stock minus abnormal opening stock is equals to normal opening stock. Then purchases. Purchases are 54,000 and sales is 61,400. Now let's see, this adjustment is left out. Let's look at into it. One fourth of the original stock of this item was sold in June 2024 for rupees 1,400. Here clearly mentioned one fourth of the original stock. Original stock is for 10,000. Then one fourth of original stock, which comes to here. Here let's see. Okay. One fourth of one. One fourth of original stock is equals to 10,000 into 1 divided by 4, which comes to 2500. Ah, which is sold for how much? 1400. Then abnormal stock sold for 2400. Sorry, sold for 1400. Here, one fourth of the original stock of this item was sold in June 2024 for rupees 1400. Sold for 1400. Then the normal sales for the year is till the date of fire is equals to ab- total minus abnormal sales, which is 60,000. Then and the remaining was considered to be worth 60% of its original cost. Here, here 2500 worth is sold here. Here 2500 worth is sold here and 5000 worth is sold here. Then the remaining is 2500. Let's calculate here. First we sold 50%, then we sold one fourth of the original stock, which is 2500. Then the remaining is equals to this plus this. Okay. Total abnormal stock was for 10,000. Then original, then the remaining stock is equals to 2500. 2500. Then how much it is valued, and remaining stock was considered to be worth 60% of its original cost. 2500 into 60%. Yeah. First we sold 50% of the original stock, then we sold one fourth of the original stock, which comes to 7500 worth of stock we have sold and incurred some amount of loss. And and here the remaining is in 10,000 we sold 7500, then the remaining is 2500 into 60%, it is saying the worth is considered, then is equals to 2500 into 60%, which comes to 1500. Then the loss is 1000. Then the loss is 1000. How? 2500 minus 1500. Then the abnormal loss is 1000. Then total abnormal loss for the year is here. Here we sold 2500 worth good for 1400. Then 1100 is the abnormal sale, abnormal loss due to sale, plus then here 40% worth we have with written off, which is 1000. Then total abnormal gross loss is 2100. 2100. Then let's see any other information is given. Okay. This is given. Okay. Let's calculate gross profit. Gross profit is equals to normal sale. Normal sale into 18.5%, which is 11,100, which comes to 11,100. Then let's balance the account. Close the account by balancing. Here 60,000, but the debit side total is how much? 91,900. Here, the another one catch 31,800 when we considered the remaining abnormal stock is 2,400, but remaining abnormal stock valued for 5,000. Then the balance should be added back, which is written off should be added back to closing opening balance for the next year, which is 31,800 plus 2,400 is equals to 31,800 plus 2,400. Is that correct? No, 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 no. 2,600 because 5,000 is the remaining value of goods, but we are valuing it for 2,400. Then how much we have written off is 2,600. Let's add it back 2,600. Then it comes to 34,400 and the normal stock opening stock is 29,400 and the debit side total will be 94,500. Here 5,000. Ah, debit side is in higher value. So let's take that and closing stock is equals to closing stock on the date of fire is equals to total minus remaining credit amounts. The balancing figure, which is 34,500, is the closing stock on the date of fire, which is normal stock. Then abnormal stock is equals to total minus sum of remaining amount on credits. So 1,500 is the abnormal good, which is 2,500 into 60%, which comes to 1,500. The balance total will be has to match horizontally as well as vertically. 90 99,500 99,500 minus same. Ah, here we have left the gross profit to enter in the done. Then now we know closing stock on the date of fire is 34,500 is the normal stock, 1,500 is the abnormal stock, and 36,000 is the total stock available. Then uh, let's calculate actual loss, actual amount of loss. Closing stock on the date of fire is equals to total we have to take, then the salvage is equals to 12,000. Fire extinguishing expenses is not given, then they incurred they have not incurred fire extinguishing expenses, assuming that, then amount of claim is equals to 24,000. Do we have any policy amount information, insurance policy amount information? Yeah. Policy was taken for 30,000. Then the closing stock is for 36,000, which is stock is 36,000, but AB 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 is insured for 30,000, which is under insured. Then average clause. Through average clause, we can calculate amount of claim. Let's calculate that. Policy amount is 30,000 Policy amount is 30,000, which is underinsured. Okay. Then how to calculate amount of claim is equals to policy amount policy amount divided by what is the policy amount? 30,000. 30,000 is the policy amount. 30,000 is the policy amount. Stock on the date of fire is 36,000. 36,000. Then actual loss is equals to 24,000, which comes to 20,000. Amount of claim is equals to is equals to 20,000. Thank you.